Hey everyone, welcome back to Mortgage Market Minute. I'm Chen with Simple Mortgage. Today we've got 4 stories to cover: new FHA rule changes from HUD, where mortgage rates landed this week, why oil prices and mortgage rates are moving in different directions, and the latest inflation numbers. Let's get into it. HUD just announced 14 changes to the FHA single-family mortgage insurance program, part of roughly 150 changes made over time to streamline the process. A few highlights: lenders won't need field reviews for some FHA loans anymore. That's a big deal since each review can cost up to $425. HUD estimates it'll save the industry about $3.3 million a year. There's also more flexibility on contractor payment draws for home rehab loans and some quality control relief for lenders operating in natural disaster areas. This could mean faster closings and lower costs passed along to borrowers over time. That said, making appraisal field reviews optional does carry some risk of less accurate appraisals, and FHA loans will likely still close slower than conventional loans, since the real delays usually come from property condition inspections and manual underwriting, not field reviews. The average 30-year fixed mortgage rate rose slightly this week to 6.49%. Up from 6.47% the week before. That's now 6 straight weeks hovering right around 6.5%. 15-year fixed rates also ticked up to 5.84%. For a little context, a year ago, the 30-year rate was 6.77%, so even with this small weekly increase, we're actually in a bit better spot than we were last year. So why are rates staying elevated when oil prices have come way down? Oil spiked after the US-Iran conflict began in late February, peaking around $117 a barrel in early April. Since the ceasefire agreement was signed on June 17th, oil has dropped back to around $70 a barrel, close to pre-war levels. But mortgage rates and the 10-year Treasury yield have only just started following oil lower. Part of the reason is the bond market got spooked by a recent hawkish tilt from the Fed, and the Fed has signaled it could raise rates at least once more before year-end. There's a view in the market that new Fed Chair Kevin Warsh's focus on price stability may have been misread. The thinking is he actually favors lower rates and doesn't buy into the usual trade-off between unemployment and inflation. If inflation slows and the peace holds, rates could eventually catch up to where oil has already gone. Last one, let's talk inflation. May's PCE data, which is the Fed's preferred inflation gauge, came in hotter than expected. Headline PCE rose to 4.1% year over year, the highest since April 2023. Core PCE, which strips out food and energy, rose to 3.4%. The Fed's target is 2% for core PCE, and we've now been above that target for more than 5 years. Inflation was actually getting close to that target in early 2025 before last year's tariff policy, and then the February US-Iran war pushed it back up. So to wrap up, FHA rules are getting simpler, mortgage rates are holding steady near 6.5%, oil is down but rates haven't fully caught up, and inflation is running a bit hotter than the Fed would like. As always, this is educational information only, not financial, legal, tax, or mortgage advice. Every situation is different, so reach out if you want to talk through your specific numbers. Follow us on Facebook, Instagram, YouTube, X, and LinkedIn. Just search Mortgage is Simple. Drop your questions in the comments. Thanks for watching, and we'll see you next week.